Welcome back to my channel, guys. So this video will be for those who want to improve their cryptocurrency strategy by providing another toolkit or another item to your mental model, just a little bit of math and comparisons to create a better mental model to increase your cryptocurrency strategy. I would highly suggest that people would go through this process if they wanted to invest, because improving your mental model will increase the returns that you get through this, through investing. So this is something called the KELLUM formula, and what this is this is an equation that allows for us to understand how much of our portfolio we should put into a particular investment, or in this, risk item. An investment is a risk item. It could fail, it could succeed. And for this particular formula, it tries to aim for it tries to, this is like a scenario where it's a win or lose scenario. Like, you lose everything in a losing scenario and you win everything in a winning scenario. But what this formula does is it allows for us to get an idea of how much of our portfolio we should allocate to a specific item. And it's quite an amazing thing to, and I would say it's a powerful formula. And billionaires use this formula, okay? Like, this is a very common formula to be used by, the rich, because rich people, the people that you supposedly want to be like if you're an investor, they try to think of everything in probabilities, and so they, and this equation is very assisting in deciding how much of your portfolio should be allocated to a particular risk item. So, okay, so we have these particular numbers that we're going to, like letters in here, that we're going to take a look at. So B is the percent return that you would get. And what is percent return, right? So you can see that B is right here in the equation, and then it's divided by B for this equation, and it's the percent return. So what is percent return? It is the amount that you get back after you sell the investment, minus the initial amount that you invested, divided by the amount that you invested. So if I put in $1 and in 2 years I sell it for $2, for every dollar I put in, I get $2 back, minus $1 equals 1. 1 divided by 1, that is 100% return, okay? So that, this is in the, it would be 100%. It's, it's a percent-based item. So, and then there is P, which is the percent win chance. So you can see, like, you're getting a multiple of the return minus, the probability of loss. That's what this 1 minus P equals. 1 minus P is the percentage possibility of a loss. And so you get this formula, and it's quite a simple formula, and it delivers powerful understandings. So here's the equation written out in a more easy to understand way. It's the percent return, percent times the percent win minus the probability of loss, divided by the percentage that you would win, and that gives you the proportion, the portfolio position size. And I highly suggest that if you want to know deeper, like what this looks like, go ahead and look up KELLUM formula, and go over several videos on that, so that you can, get a deeper understanding. But here we're going to give an example of how this KELLUM formula could help improve our mental model to be a more successful investor. Just as an idea, you may not even need to do math. You can just use the ideas presented here to get a better idea. Okay, so let's say there's these two boxers, and the market, gives it these odds, right? But so the market gives a probability that this guy is going to win, it gives you this payout. Like, you're in a betting scenario and you're betting, and this is what you'd get back. You put $1 in, you'd get $1.90 back. So what you do, that's 90, like, you fill in the formula as I stated before, right? But this right here is what the market is saying the odds are that this guy will win or this guy. So you can see they're very closely matched, but this guy has a slight edge for whatever reason from whatever data. You know, like if you're in the sports or whatever, you come up with probabilities for that this guy is a slight edge on winning. And so the market in the betting odds will, you know, be adjusted automatically for that. And so we run it through the formula, and in fact, we come up with a negative number if we use the market's data, right? The market has an assessment, like we have some output that the market is expecting for the probabilities of winning. And, you know, like, and you use like, oh, like if I place a wager, I'm going to get 90 cents back per dollar. And it tells you you should not take this bet. But and you know, this looks similar to how you would see it in real life, because you know the house has to take some cut, and the house taking a cut causes it to be negative. But let's say you have a unique analysis, an AI engine, or your own model, or your own process, okay? And what it says is, no, this guy actually has a 55% chance. This guy has a 45% chance, because you really do trust this model. You know this model is accurate. Then we run that through the scenario, like this equation, and we get a profit because we have an edge. This analysis gives us an edge, and you know, like this is how you become a wealthy, is having some kind of edge. It could be your analysis. You must have an edge. Otherwise, you will fail. You will take bets that are negative. But this shows you that you should allocate 5% of your portfolio to it using this equation, because you're saying, yes, you have an edge, but still the odds are pretty big that you're going to lose. But if you were to play this game mathematically over and over and over again, each time you would throw in 5% that you would play this game, and you would get some growth from your portfolio from statistical probabilities alone. So that's what these mathematical models represent. Okay, so basically what the Kelly formula is you have a probability of winning for your investment, you have a total balance, you have an expected profits, and you have the probability of losing, and that will allow for you to get this position size. Okay, so why is this important to us as crypto investors? So I want you, like now I'm going to start diving into some ideas so you can get a good grasp on why people, you know, like why there's so much chance of making a profit. So there is some useless coins in the cryptocurrency space that are garbage, and people are investing in them. And you know, and so we can know in our minds that the probability is pretty low for these things, right? Like we can make a pretty good assumption that if we're long-term investors, that some of these coins have pretty low possibilities of delivering a significant return, because for obvious reasons. You know, if you put in the research. You know, and so when we think about crypto investing, we want time frames. For me, I think in crypto, you know, like I think crypto will outperform everything for this decade. So everything else is irrelevant. Like I'm thinking about, you know, when you're thinking about what you're going to invest in, you're thinking in terms of other stuff, in cars, gold, the stock market, homes, the dollar. Okay, so you're thinking about other stuff. I think crypto will outperform everything for this decade. So for me, you know, like I'm going to try to present you with some of the ideas that show not only is the market wrong in crypto, right? But if we give this analysis, we could push our performance. Not only is crypto going to outperform everything, but we could push our performance against cryptos by doing the research. And the reason why is because we can see obvious stupidity in the crypto market. So let's take a look at some concepts here, right? So proof of high returns ahead. So if you do your due diligence in this market, you will be rewarded. Even now, crypto is still early. We're in the early years of crypto. So take a look at this. This is a useless coin, okay? And we have this project right here, which is a Celsius network. And I'm going to dive deeper into Celsius in a minute. And even Algorand, a very powerful project, okay, that are undervalued compared to a completely worthless gamble, okay? And, you know, you could even see from Celsius, there's, you know, like a 1.42x just to catch up with this junk, okay? And so what I'm saying here is the market, it's showing you that the market is not very bright. And that is why crypto is offering us such a high returns ahead. You know, these people that are in the space, they don't know what they're doing. Like, it's just easy to even see that. You know, and so what the market, like, if we add research to our approach to crypto, we increase the probability of, you know, of finding wins. We can more likely assess winners. You know, like this, when you're doing your research, you're going to come up with some probability for what are the odds that this will win. You will come up with some idea of what are the odds that this will win, you know, and we might not even be able to come up with exact numbers for this, but we can come up with the generalizations, and we can do it comparatively. We can compare the cryptos to each other. So I want to ask you a question. What is more valuable? Something that is completely useless, that has no one like doing anything valuable behind it, or a company that is going to keep growing users, who has one of the greatest inventors, behind it, a CEO who started several billion-dollar companies, and he's, you know, running full force ahead with this company, and it's a very enthusiastic community, and there's a lot of, the token actually represents growth of that project. So which one, you can see there's a comparison here. That is, I'm not making numbers here. You can use your brain and see that there is a very big disconnect in these markets. And so we can know that we can do an analysis, and over time, we are going to come out winning higher, like on the higher end of the probability curve of the average crypto investment compared to everything over time. So with my assumption that cryptos can outperform everything over the next decade, and I still believe that. Okay, so now, like, hopefully you can see that there's a huge opportunity here to do your homework, and this Kelly formula really does help us understand that, you know, the market's giving more of its value to junk and then is out there. So we can do an analysis and get closer to what is considered winners. Okay. Hopefully that you find this somewhat helpful. Okay, and so one last comparison we're going to take a look at why I think that crypto not only is there a huge disconnect inside of the cryptocurrency markets, where the market is making one assessment and we can make our assessment. We can get a larger share. We can get a larger share of quality stuff because it's discounted compared to other things. And so all we have to do is put in the analysis work, and we're going to get paid quite heavily for that. But not only is there this dysfunction inside of the crypto markets where people are misallocating money, but there is a misallocation compared to the stock market. So if you look at here, this is the stock market Shiller PDE ratio, and the PDE ratio is profits to earnings. Like, it is the ratio that companies typically should be held at, and it should be roughly at this number, 15. And you could see that we have these little green cycles and down cycles and green cycles and down cycles. And I added some events in this timeline as well. So you can see the market is actually on the high end. So this is not a place we want to put our money. This means, like, that right now, the stock market is overvalued because the Shiller PDE numbers are disastrous. We're even in statistical, like, red zone, okay? In the very bad statistics. This is where we are right now, in the statistical dead zone. You do not want to put any of your wealth into something that's overvalued like this. And, you can even see that we've been in this very long green period. And one of the reasons for this is the monetary constraints. We have no more monetary constraints since 1972. And you could see, since that happened, everything broke in the stock market. The stock market doesn't go down anymore because there are no more monetary constraints since we've left, the standards that tied the dollar to gold, but these PDE numbers, okay, so I want you to say, okay, so we're looking at this overvalued stock market. Now let's take a look back at Celsius, one of the projects I like, and there's plenty of projects I like in crypto, but Celsius is one of my favorites. That's you'll see why. So I think now, in a bigger picture, I do think that the stock market can keep going up. And what this is called is the crack up boom. It's called when the crash, of credit breaks down in a system, when the monetary system breaks and when there's high inflation, we have something called the crack up boom. Ludwig von Mises is the one who coined this. And so I think that this stock market might not actually pull down. It might actually keep going up. But even with that considered, it's going up in terms of dollars. And like I said before, we want to think about things in terms of against each other. We want to think about like cryptos versus the stock market, cryptos versus, crypto versus gold, whatever. And what we're looking for is clues as to what the market is assessing things at. So this project actually has a P2E. And because it does, that can allow us to get a general idea of how crypto in general is being assessed in comparative to the stock market, because we actually have something that gives us a P2E. Celsius represents an index of crypto, so that's one of the reasons I'm very excited about it. It captures growth of its users, and the assets under management are about 15 billion. And so what they can do is they lend out, we don't care about even what they get in return for lending this 15 billion out, because they will be getting like the basic application rate, the time value of money rate, the lending rate of their money. So it really doesn't even matter like what they're getting. And they are, I know, getting about 5%, between 5 and 8% for their assets under management. So what this allows for us to do is to come up with a PDE for Celsius. And what it is saying that Celsius should be about the same value as assets under management, because they lend out their assets under management for the common going rate, and the common going rate is the Shiller PDE 15. That's what it should be, okay? So we know that this should be times 15, because that is the Shiller PDE ratio. So when we know that, we can say that this should, this project should be equal to 15, not times 15. And so we know that because this is the assets under management, they can lend that out and they get the common rate for all of this. This is what produces their returns. And so their current evaluation is $2.5 billion, $2.4 billion. Divided by their current assets under management gives us 16%. In other words, there is a 625% potential profit to get Celsius to the average P2E. So it is undervalued by a factor of 6 to get to the average. And the stock market is in the 37 range. So, but let's just say that's a 2x. So if the Celsius was to get to catch up to the market's evaluation of being overvalued, that would be a 12x our money. So it shows you that crypto is still heavily undervalued comparative to the stock market. And so, if you were to, this is kind of irrelevant if it was valued like the rest of the market. But it shows that just to get to the average, the historical average, we would be seeing a 600% return for Celsius, where it was when I produced this video. And this is also making the assumption that Celsius will have zero growth in the future. Often, projects will have a higher PDE number if they expect future growth. And I want to ask you the question, do you think the stock market is poised to grow? We just experienced one of the worst disasters, the COVID situation, that doesn't make the stock market look that healthy. What this is really is being artificially held up for money. But okay, so but that should, what I've gone over so far, hopefully gives you an idea of a comparison of crypto versus the stock market, and we can see that crypto is being treated poorly. It's treated undervalued from an unbiased point of view. And it's even undervalued in the sense of saying that this isn't going to grow. Like in the VC world, Celsius is going to experience rapid growth, guys. It's probably going to 100x in users. It's at 1 million users roughly right now, and it's probably going to grow to about 100 million users. That is 100x in growth. But just to get to it, a regular average evaluation is a 600% return. That means you can get a 6x times 100. So we can see 600x. So these are the type of returns that is available to the cryptocurrency investor who thinks long term. If you just buy and hold quality projects, don't put all your money in one basket. You know, this equation, the Kelly formula says, you know, even if something's a really good investment, and if you put too much into it, the formula actually show you going down. So you want to take several bets in the cryptocurrency market. Okay, so nothing here is investment advice, but hopefully this video gives you guys an idea of how you can use math to come up with formula allocation. You can see that if you do analysis, you're going to beat the market because the market is obvious signs. Like, we're looking for clues here, right? We're looking for clues that show us whether our decisions are right. Everything else put aside. We can see the clues. We can see the clues that there's garbage within the crypto market, and there's crypto is undervalued compared to the regular market. You know, so there's huge. So what that means is you're going to outperform the average of every investment class that I can think of. By just being involved in crypto if you do a good job at picking things. Okay, guys, so hopefully this video makes you, excited. The idea here is that there is evidence all around us. Look for the clues. Use your mind. You can see that there is clues everywhere as to whether there's logical assessments in the right areas, and you could take advantage of opportunities. They don't last forever. This junk being in the market isn't going to be here forever, and someday there will be intelligent investing. And when that is the case, you won't be having these huge discounts, and you will heavily outperform everything. And that is the goal of an investor, is to heavily outperform everything. All right, guys, hopefully this gets you guys excited. It certainly does for me. I look forward to bringing high quality content in the future.